The analyst behind that call joins us now, Needham senior analyst Bernie McTernan. Bernie, good morning and thanks for being with us. Now, for as long as I can remember, the street has been bullish on Uber, but it has spent most of its life as a public company below its IPO price and certainly below that private market valuation when it was thought as this extremely disruptive company. What gets it to $54 a share? What is that valuation based on?
Yeah, so I think there's a couple of things that we're looking at here. And first, I think the valuation is much more reasonable than it was in years past, especially when we were talking about revenue multiples. Now that we can look at EBITDA multiples fully, and they're actually one of the, if we'll call it the fender of stock-based compensation, only about a mid-single-digit % of their revenue goes to stock-based compensation. So even if you look at EBITDA X stock comp, still trading at 20 times 24 EBITDA. But one of the reasons why we're bullish on Uber heading into next year is this emerging revenue stream with advertising. They have a $350 million run rate right now for advertising revenue with the goal of getting to $1 billion run rate at the end of next year. And we hosted an expert call with an ad buyer. And really the time is now for these retail media networks, given the signal loss from IDFA that Facebook is facing to really go after, and especially if you're a closed loop ecosystem where advertisers can advertise on the platform and that consumer is making the purchase there, there's a huge opportunity. So we think that billion will ultimately prove to be conservative for Uber in 24. And importantly, this is high margin revenue for Uber as well too. So you're talking about like a 90% gross margin. And so that's one of the reasons why we're bullish.